I'm Kevin Becker. I'm the CEO of Kiski Group, and I'm here today with Connor Browne, who is a founder and the CEO of City Different Investments. And introduce yourself, Connor. Just tell people who you are.
Yeah, sure. Good to see you, Kevin.
Same here.
We've worked together a long time.
Yeah, a long time, actually.
Yeah.
It's over a decade, I think.
From our prior firm, well
Sure.
before we started City Different Investments almost 5 years ago. Okay, so my background briefly. I grew up in Pittsburgh. My dad grew up in Pittsburgh. He was a priest and a social worker before he started an independent financial advisory firm there in the 70s. He built a big business. I'm super proud of the business he built, treated clients the right way. But I grew up around investing. I was more interested in comprehensive financial planning. I was more interested in investing than comprehensive financial planning.
So you got it backwards. You were first you were going to plan, and then you said, no, I'll just invest. Okay, sounds good.
And so I used his firm to try to find small shops off the beaten path, with good people, good philosophies and approaches. And I landed summer before my senior year of college in Santa Fe, New Mexico at my former employer, Thornburg Investment Management. Loved the experience, turned down some job offers in New York, even though I knew who my roommates were going to be in the city, to take the full-time offer in Santa Fe. Lived out there ever since. Spent almost 20 years at that former firm. And then 5 years ago, me and a handful of my colleagues from the prior shop started City Different Investments together.
So, and you're in Santa Fe now, right? I mean, you stayed.
At the moment, I'm recording a podcast with you in the Village, a very cool part of New York City.
Yes, we're in New York now, but I mean, the firm is still in Santa Fe.
Firm is based in Santa Fe. Me and Christine and I are raising our kids in Santa Fe. It's been a wonderful place to live and to raise a family.
Oh, this, City Different, obviously difference in the name. So we've talked about that.
See what we did there?
See what we did there, yeah, City Different. I mean, I think why don't we just start there in terms of, the concept of different. But before we get into the philosophy or why you built the firm or you and your partners have built the firm the way you have, let's do, CDI by the numbers, so number of strategies, people. So what's the kind of shorthand of how we should be thinking about City Different? Yeah,
absolutely. There's about 15 people at the organization. We're almost 5 years in. We're a bit over $200 million in assets under management. And we run strategies across four main product areas: laddered investment grade fixed income, focused global equity, focused domestic equity, especially a SMID cap strategy. And then we have an arm that does private investments, especially small business acquisitions and some real estate.
And you are a hands-on CEO, as in a portfolio manager yourself. Maybe talk to us about what strategies you run.
Yeah, so Rob McDonald and I manage City Different's domestic equity strategies together. Rob and I have worked together since 2007, doing very similar work at the prior organization.
And so, great. Now we have CDI by the numbers, and we sort of know what you do. Let's talk about the different part. I mean, I think it's kind of the fun part too. Your ideas about culture and where alpha really comes from in the investment industry. I love those concepts. So, maybe give us a look into why CDI is called City Different.
Yeah. You come from a hedge fund background,
I do,
Kevin.
Indeed. I do indeed.
Tiger Cub.
That's it.
Worked with Julian Robertson.
Yep. And Steve Cohen.
So I don't think I think this resonates more with investors that like that sort of model. So it sounds a little bit less different maybe to people that are thinking of hedge funds in that context versus who we generally compete against, which are long-only investment management organizations. Broadly, I think the market for investment management firms is broken. I think the way that those firms operate is broken, and it has investment teams at those firms spending way more time on bureaucratic BS than on actual investing outcomes for their clients. So in our early days at our prior shop, we had the awesome experience of being in a very entrepreneurial, very flat culture that supported outstanding results on behalf of our clients. And we've been really thoughtful in how we've set up the culture. We've set up shared ownership. We've set up long-term incentives at City Different to recreate and improve on that model so that our investment teams are spending as much of their time as possible on work that benefits our clients, our investors, and that they ideally get the opportunity to do this work, which is awesome, wonderful, engaging, exciting, competitive work in the way that they believe is best. They're chasing their passions. They're doing it the way that they want to, which attracts great investors to City Different, ideally retains great investors at City Different, and allows them to do the best work that they know how on behalf of our clients.
So, from an allocator's perspective, and just as a shout out, you have a wonderful video on your website that goes through in depth your thoughts about culture and people and where alpha comes from. And I would encourage anybody to look at it because I think it describes, or if it's available on your website. But it was very good and very informative in terms of how you think about the business. From an allocator's perspective, give us your thoughts on alpha generation and where that comes from and how you relate that to the cultural aspect of the firm that you and your partners are building. Because I think it's, where does this show up in results in your mind, and why is it, you say it, the investment process is broken at these larger firms. How does this show up in portfolios, and what should an allocator be thinking about when they're talking to you?
Yeah. I think time horizon arbitrage is sort of one of the last opportunities available to active investors in a world that moves so quickly. There's so much information out there. Processing information, putting trades in is measured, and how fast light can travel across fiber optic cables these days. An informational edge, I don't think is where it's about anymore. So, let's focus on our equity strategies for a moment. In equities these days, I think it's about having a differentiated approach that can really focus on long-term outcomes. And all of those things that I said, or that I like to say about the standard investment management firm in our industry, really big institutional organization, I think generally all of the meetings, all of the red tape, all of the layers of supervision tend to shorten the time horizon around how people are measured. If you're a chief let's imagine you're an analyst reporting to a portfolio manager, reporting into, let's say, a head of equities, reporting into a chief investment officer, reporting into a CEO. All along the chain, there are individuals whose performance in their job needs to be measured over time periods that are much shorter than, say, the 3 to 5 years that I think it's reasonable to measure an investor's results. And so quarterly trustee meetings, monthly risk management meetings, all of this natural cadence where things happen, you have all these meetings, and everyone has to report up the chain on the value that they're adding, overseeing these people, creates this crunch on time horizons for the investors who are investing the money at the firm. So being really thoughtful about building an entrepreneurial firm where each of the investment teams at City Different feels like they're building their own entrepreneurial business on the platform. They're investing how they want to. They're managing risk the way that they believe, with oversight. And I'm excited to talk about how Kiski helps us with that oversight. But that, to me, aligns long-term interests. If we can just attract these awesome investors and let them do their magic without all of these meetings along the way that'll tend to shorten time horizons and make people worry, make investment teams worry about things that they maybe shouldn't have to be worrying about. I think that's where our real value add is over the long term. Each of our teams running strategies has their own philosophy and approach. They've got a process that they believe in, that they want to follow. we're not forcing company-wide process onto them and making them do sort of BS that they don't believe in just because up the chain, that's what's required. And I think there's real magic there.
Well, let's talk, which I appreciate. And I know that, your teammates in your firm and your partners appreciate that as well. But let's talk about the gorilla in the room, which is the benchmark. And I mean, whether it's your fixed income business or your equity strategies business, there is a benchmark. And in some ways, the competition is passive investments into an ETF that, is just a benchmark algorithm. So how does that impact your thinking about where value is created and alpha is generated?
Yeah, we are aware of the benchmarks in each of our asset classes that we're comparing our long-term results to. Like, that's fair. And let me just go into our view on risk management, honestly, because that's some of what the question is about.
I'm going to get there because I think there's a really interesting quote that you have about risk that I want to get to for sure. But let's just talk a little bit about the passive industry and how you and your partners are thinking about portfolio construction, investing, what makes a good investment, how something gets in a portfolio. Let's talk about that before we talk about the risk, which I know is the other side of the coin, and I kind of know what the answer is here. But I want to hear you directly address that because I think it plugs in very nicely to your culture thesis.
So we believe there's a place for active out in the world. But you've got to look different than the benchmark. In order to outperform, you've got to look different. So once again, organizationally, culturally, we need to be supportive of looking different with high tracking error, which is scary to some investors, but high tracking error, very focused portfolios on the equity side, such that we can really generate, ideally not a little, but a lot of outperformance over the long term. Once again, time horizons. You can't invest in any of our equity strategies with a 3-month or a 6-month even time horizon. You need to expand out your time horizon because results along the way with high tracking error are going to be bumpy. But to justify an active fee, I think you need to look different. I think we are aware of the benchmarks we're comparing against and what's going on in the world, but we are not afraid to take active risk. For example, our global equity strategy today has no exposure in information technology or healthcare, two of the largest weights in the equity. And we're comfortable with that exposure. With the right time horizon, we need the individual names in our strategy to be great. We don't need a little bit cafeteria style of everything that the benchmark's offering up.
Well, I noticed, the number of positions in your equity strategies, it's pretty
low 20s.
Yeah,
that's
pretty
juicy.
It's pretty concentrated. And yes, and you're definitely taking a view. And I think that's where I, can tie it back to the cultural issue that you're talking about, because in order for someone to have the courage of their conviction to create a high tracking error portfolio, as we were saying, or to drop the jargon, to find 20 companies that they want to own for, the next 3 to 5 to 10 to 20 years, that is very different than how people are being benchmarked on the street. You could have a year where your non-IT, non-healthcare driven portfolio could look terrible. How does that work internally when you're accumulating a group of investment professionals? Their passion has to be finding that company, that particular security that they all want to have. And how do you keep that from getting mind melded with benchmark hugging, benchmark thinking, looking over your shoulder at the competition, looking at the soup du jour, which is, AI is the soup du jour today. How does that work at CDI?
Yeah, I think patience is the answer. And some of our potential clients don't like that answer. They want active management of the portfolio managers to making sure that in every period they're doing everything they can to not be missing anything. But that is just not how we operate. At our best, I think a great example is our global equity separately managed account strategies, which have been up and running almost 4 years. Vin has owned very little of the big names that have driven the S&P or the ACWI over this same period, yet has found other names in other sectors that have driven more than 1,000 basis points of annualized outperformance, which sort of reiterates, like, there's always going to be an NVIDIA out there, whatever that is and whatever market we're in, but you don't need to own it in order to drive great returns for clients. There's a huge universe of other potential investments that could just do just as well or better. You've got to be willing to find them, put them in the portfolio at a big weight, and have the time horizon to hold those investment bets out.
And when you're talking about sizing and portfolio construction in these high conviction portfolios, conviction I think is a word that's very much overused on Wall Street today.
We really mean it.
I know. Yeah, no, it's funny. It is interesting. You do, because the results in a way speak for themselves. But when you're trying to come up with that level of conviction, and then you're saying, "Here's how I'm going to size it in a portfolio." How do you guys even approach that topic? I mean, as a group or as a PM, like what's the conversation like around the table when a new idea is getting vetted?
I love the idea that to truly be different, like we need to own that our answer to some questions aren't going to be satisfying to a whole bunch of investors, potential clients out there. So I think my answer to this question is not satisfying to a whole lot of allocators out there in the world. But it weighs heavily on experience. It weighs heavily on the excitement that the teams have around other names in the portfolio relatively. We have this awesome background of having been global generalists at our decades together at the prior shop. So comparing lots of different investments and the risk reward across different sectors, I think, has benefited each of the investment team members. That's how our fixed income team approaches their work too. Sizing has a lot to do with, bit of a gut feel on the portfolio management team side, with tons of experience and knowledge about an industry, knowledge about the other investments in the portfolio and how they're all going to work together. Once again, I back my portfolio managers in the way that they want to run the money that they're running. Our domestic strategies do utilize a basket structure that Rob and I believe in, that we've been operating under for a long time, that creates some limits around the kinds of investments that can be in the portfolio. We call them mature, established, and emerging by basket. But our global strategy, Vin's strategy, does not have those same limitations. He has, our client should know he's got a big portion of his own net worth invested in the strategy, as do I in all of our strategies. He's being very thoughtful about the names as they fit together. But there isn't a formula that defines how big those initial positions are going to be or how big a collection of weights could be in that portfolio, which makes some allocators nervous.
No, but I also think it's consistent with the investment process, right? I think if you talked about it differently, than a lot of the other things that you said prior would be hollow. I mean, in other words, this is an organically constructed portfolio construction process, and you just say, this is what I like, and here's what I believe, and I have to believe that you have, why don't I just ask the question, price targets. So what do you think about price targets, and how do you factor those into your thinking, and how are they derived? And when somebody comes to you and says this stock's at 100 and I think it's going to, how do you have that conversation?
Yeah, I think each of the equity portfolio management teams, so Vin and then Rob and I, with Rob really leading our domestic effort, have slightly different approaches. But for sure, in both cases, we have a current view on every name in the portfolio of what we think intrinsic value is. I know for Vin and our global strategy, he likes to say, we're looking for stocks that aren't just a little undervalued, that are a lot undervalued, which to him means the opportunity to go up between 50 and 100% over 3 to 5 years. So none of this consumer staples trading at 22 times, we really think it's worth 23 times forward earnings. Like, no, that's not how we operate in terms of the discount we're trying to buy an investment at. And then across both of our equity strategies, Rob and Vin are tracking fundamental development against sort of guideposts that they've laid out along the way. Vin calls this path to success, which he defines for each investment as he gets in. And as we get earnings reports and other developments in the industry and at a company, he'll be adjusting that calculation of intrinsic value. And as we get closer, the risk reward is less interesting. We will start to reduce position size within the portfolio. And then if we get what we think is all we can get out of the stock over a period, we will sell. So, it's not a formulaic. We've got a spreadsheet that's driving the trims and the adds based on where a stock is today versus intrinsic value. But in each case, we've calculated what we believe intrinsic value is, and we're being really thoughtful about the relative position sizes and the future risk reward in the securities.
Well, you have a great quote that I'm going to massacre, but essentially to generate any sort of alpha, you have to understand what is misunderstood, right? I mean, I think you've kind of something like that's how you phrase it, and so the misunderstanding, give me a sense of how does the team think about that? And the markets are supposed to be efficient. So what is it? I'm smiling too. What do you think that means when you talk about the misunderstandings around a company or its value? And then again, each person's gonna have a different approach on your team, but generally speaking, how do you untangle that?
Yeah, I think for each investment, it's different. And one of my strongest learnings from Bill Fries, who was a mentor at my prior shop, just saw him the other day in Dallas when I was visiting. One of my main takeaways from Bill that Rob and I and Vin, I think, all carry with us in our work we do at City Different, is that usually there's only a few key drivers of a long-term investment outcome for an investment we're making. So 2 or 3 things that once you've really dug through all of the financial filings and the press releases and the earnings calls, the 10Ks, the 10Qs, the proxies, like once you've turned over every rock and you feel like, all right, there's not something big that I'm missing. In each investment, there's only usually 2 or 3 key things that are going to drive whether a stock dramatically outperforms or underperforms the overall market over the next 3 to 5 years. So making sure we understand those key things for each investment, and then understanding how our bet on one or more of those key issues is different than the rest of the market. And then, as I mentioned, laying out those guideposts to be able to track performance of the business against our path against these key drivers. Like that's how it all works. An example, a longtime holding in our domestic strategies is Grand Canyon University. I think this misunderstanding or misperception by the marketplace is a little bit easier to get your hands around. It is a for-profit, publicly traded service company supporting a not-for-profit undergraduate university. And the for-profit education space has been a mess of bad dealing, of recruiting. Sometimes these firms in the past have gone out, they've recruited veterans to get GI Bill money without any care as to whether the veterans actually graduate through the programs that they're enrolling them in. Lots of bad actors in the space have just grabbed federal loans, GI Bill money, whatever it is, however they can, without really caring about the underlying student, you can see how that whole industry is painted with this negative brush.
Right. That's the bathwater.
Yeah, there you go.
Now we have a baby.
And this is the baby. Yeah.
Okay.
And in fact, the founder, CEO, not quite the founder, but the longtime leader of the organization, Browne Mueller, has done an awesome job of creating brand around a ground university in Phoenix with Division I sports teams. They make appearances on the basketball side in the tournament most years. Like, it's a real university. We are in a neighboring state in New Mexico. More and more kids from schools around Santa Fe are heading off to Grand Canyon because Grand Canyon offers an outstanding education for a really great price, a really good, strong educational product in the brand they're trying to build, which supports an online university where, again, they're really focused on long-term outcomes. So I understand why the stock has been, for more than a decade, generally undervalued relative to what we believe the long-term value of the business is, because that whole industry gets painted with such a negative brush. But we've done the work. We've been there. We visited. We followed students and their experience through the school. We know and understand that it's different. So that's an example. But for every stock, for every bet we're making, there's a different underlying misperception by the industry. And to your point, it's important for us, we think, to understand that bet that we're making, and then how can we support whether we're right or not against it over the long term.
It's the perfect introduction to risk management. It's the absolute layup now, because I think now understanding how you're finding, how you're sizing, how you're tracking fundamental stories with a view to, largely speaking, creating wealth. I mean, most people are talking about beating a benchmark or an index, and it sounds like you and your partners are talking about creating wealth for your clients. And that's, again, it's a little old school, if not, almost unheard of in this market, because the benchmark is supposed to create wealth, and then you're just supposed to add a little bit on top. And it sounds like you have, and I know you have a different thought about that. Even again on the fixed income side, there is a bias to having conviction around portfolio construction and security identification that isn't just let the benchmark do the work. In most of the industry, the benchmark is the risk management tool. Because, market down 20, you down 18, hero, right? That's kind of the thought. So how do you think about risk management, and especially in a super high tracking error portfolio, how would you think about that topic?
Yeah. I think the most important line across all of our strategies and risk management at City Different is that our risk management is portfolio manager led risk management. It's important to have oversight over the portfolio managers. I actually agree with allocators on this front. But to me, the way that we do that is our portfolio managers define what it is they do and how they're going to manage risk in the portfolio. What have you committed to as a portfolio manager with regard to running the strategy? And then we use systems to check to make sure that our portfolio management teams are doing what they say they're going to do. So before we get to equities, because I want to talk about our partnership with Kiski, Kevin, let's talk about on the fixed income side. Chris, Ryan, and Shweta Singh, our co-heads of fixed income, have been running money together for clients for almost a decade. Chris has got a long history. He ran all of munis at Vanguard in the late 90s and early 2000s. He's a very modest guy, but a guy in his team that I caught up with who was on his Vanguard team way back told me, Connor, like Chris would never say this, but back then he was running more in municipal bond assets than any other human being on the face of the planet. He and Shweta together had a really successful run at Thornburg, running tax-exempt securities there. So Chris and Shweta, have strong opinions about how to do credit work and then how to put those credits together in a portfolio that's managing risk on behalf of their clients. To them, they are total return managers, die-in-the-wool total return managers. They think that yield maximizers have it all wrong in their industry. And if a financial advisor or an allocator comes to us and says they want a yield maximizing portfolio, Chris and Shweta will say, no, that is not what we do. That's not how we believe money should be run. And at times we'll give up yield on our strategies because that's not their focus. They also believe a ladder is the best way to manage duration risk in what is always an unpredictable interest rate environment. So, a client comes to us and say, what I really want is a bullet. What I really want is a barbell. They'll say, nope, ladders. That's how we believe in doing it. Now, I have risk reporting that will show across every one of our accounts how we're doing in terms of security concentration against the limits they've set up, and where each of the rungs on each of the ladders in every one of our client accounts is set to make sure that the team is doing, as I said, what they said they're going to do. But I, as the CEO, I got no business telling Chris and Shweta what the best way to run a municipal bond or an investment grade laddered bond strategy is. So that portfolio manager-led risk management we think is really important, and it clears the way for some of this BS at big institutional organizations where, you might spend tons of time into a monthly risk meeting just trying to figure out what in the hell your risk software is saying about the portfolio, not to mention then reporting to risk managers with teeth. I think it again can be a big distraction from the work we do on behalf of our clients, which gets me, this is a long answer, I apologize, but this is important, gets me over to equities, where we've been working with Kiski, your firm, for a long time. So from predecessor firm now through to City Different. And, I've seen, we've worked with FactSet, R Squared, Barra, Bloomberg. We've looked at BlackRock's capabilities. Like at the prior shop, we had all of the resources. We were looking at all of the different risk management systems. And generally, they were all a mess. I remember coming in one day, and our domestic strategy was showing really out of weight risk exposure to mid cap Japanese banks. And Rob and I looked at each other like we don't know anything in Japan.
Right,
Like,
right, exactly.
What is going on?
Yes.
Yeah, and then you spend all this time trying to figure out what that's about and why and justify it and like whatever. Whereas what I love about our work with Kiski at the prior shop, which is why we've continued working together at City Different, is that you've been able to really custom design risk solutions that match how our portfolio managers want to run risk in our portfolios. I think the best example is the basket project that we did, where we, at our prior shop, had these definitions of, today we call them mature, established, and emerging, which is to say a value component, a consistent quality, stability component, and then a growth component in each of the portfolios, which we limit to 30 to 50%, 30 to 50%, 25% or less. And dating back to the early 2000s, we were running this approach, but we were just defining the companies as we thought, a little willy-nilly, right? What Kiski was able to do was to custom design a bottom-up fundamentals-based and regression-based definition for each and every stock in our basket structure, for each and every stock in the benchmark, so that we could actually have a check for how we were defining the businesses, whether a mature, established, or emerging, in our own language, in our own philosophy and approach, but then quantitatively backed up. So I love that idea. Like, figure out what it is you do as a portfolio manager to manage risk, and find an awesome custom analytics firm like Kiski that can match your risk analytics platform to the way that the portfolio managers actually want to run the money.
Yeah, when you're thinking about your investment style, and it does permeate, obviously, the fixed income business as well as the equity business. When I was a PM and someone would put numbers back when I was a dinosaur, so when someone would run it through, like, I think Risk Metrics or something, that, one of those old legacy systems, they'd show me a portfolio I didn't recognize, right? That's the key. And I think if you're going to have PM-led risk management, I mean, and we haven't really defined risk yet, which we will, but if you're going to have PM-led risk management, if they can't see themselves in the portfolio, they're not going to be able to articulate what their risk management process actually is. And it can't be, I would say, let me maybe pose this as a question. So your enthusiasm for a position and your thought about how that position is going to work over time relative to the other positions in your portfolio is going to define sizing in some way, right? We talked about that. So there's no algorithmic sizing. You don't start at 1% and build to 5 and then have a max of 6
But
or whatever.
we're aware of how they're going to work together.
You're aware.
That's right.
So you're aware. When you're thinking about this in terms of risk, what is risk? I mean, is it volatility? Is it correlation? Like, how do you define risk inside the organization so that somebody for whom you're trying to create or compound wealth is comfortable with PMs managing risk themselves?
Yeah, I think by investment, it's honestly risk of permanent losses on an individual investment, I think would be how the portfolio managers are thinking about it. That is measured over shorter timeframes than 3 to 5 years and performance relative to a benchmark. And so we make sure to tell anyone that's coming in, especially on our global equity strategy, that it is a very high tracking error strategy. And that while we believe, and Vin's history has been to add significant alpha over the long term, that there will be periods of pretty dramatic underperformance over the short term. You need to get in, expect that, and have a 3+ year time horizon to feel good about that position in clients' portfolios. So, it's interesting. There's strategy underperformance risk in the short term, a quarter or a year, say, which we face. There's also organizational risk. There will be periods where one or another of our strategies is out of favor. And sometimes even when you're performing well, allocators won't be allocating to that space. Our old boss, the CEO that really built Thornburg, used to say that, Brian McMahon, great guy, he used to say that we wanted to run strategies that we believed in with excellence, and that we just wait for that big stream of assets to flow our way. And I think there's something to that. I think there's something about an entrepreneurial investment management firm where teams are building the strategies that they believe in over the long term. But importantly, organizationally, I think it helps us to have more than just one strategy. And I love getting into these debates with especially endowments who want one firm, one strategy, and that's all they'll do. David Swenson model, like a lot of the Ivies, like all they'll do, one firm, one strategy. So we're disqualified. We operate multiple strategies. But to me, I think if we do this right, a couple of things happen. One, we take the responsibility for building a firm and an organization off of the portfolio manager's shoulders while still allowing our portfolio managers to build the strategies that they want to and that they believe in, not having to conform to like big firm philosophy, so you got to do it this way. But we also have some diversification and time horizon across strategies so that each of our teams can be building the strategy that they believe in the way they want to. But we organizationally know that there'll be periods where those strategies are out of favor, where they're not garnering asset flows and therefore maybe not generating as much revenue for the organization, but where because we've got multiple teams running different strategies, we can bear that risk organizationally. So there's a lot to it. I went on a little bit of a tangent.
No, I think that's, because you're describing in some ways enterprise risk, but I'm going to, be that guy and say, okay, well, now I know essentially that risk is not volatility and risk is not quarterly underperformance versus a benchmark, for example, because you can't, by definition, describe risk that way. You did say it's permanent impairment of capital. Okay. So how does capital get permanently impaired in your view? What is, in other words, what's the risk that you have permanent capital impairment, and how do you underwrite that risk?
And I mean, the bit that's frustrating is that, so simply we get our work wrong. Sometimes things
Wrong
happen,
on a name.
Wrong on a name.
Right.
Sometimes things happen outside of our control that couldn't have been foreseen. But a lot of the time when we lose money, we get our work wrong, or our bet on one of these key drivers goes the other way. So there, in each and every holding, there's always going to be some that we're getting wrong, some that we're getting right at any point in time. Cutting our losses on the ones and highlighting when we've gotten it wrong as soon as possible, not justifying a new investment thesis in a name based on a lower valuation, helps to protect against how much capital impairment we might see in an investment name. But yeah, I mean, there's
Well, no, that's it. But I think you're hitting a nail on the head, because high conviction process where you're staking a significant bet on each underwriting, of each security, whether it's equity or fixed income, reasonably speaking. And then I love when you said you can't change the investment thesis midstream. So how do we make sure that doesn't happen? Because, every trade becomes an investment for most people, right? So, I love it. And then all of a sudden they're married to it for 5 years because they're, underwater by 50%. And now all of a sudden they're investors when they used to be traders.
And it's very unhealthy marriage.
Very unhealthy.
Cases, yeah.
So making sure that you don't change the investment thesis midstream. How does that work? How do the PMs talk about it? How do you guys talk about it as a group when someone is looking at a position, mileposts are there, we've clearly not met one. Price has changed. If I loved it at 50, I'm going to want to marry it at 30. How do you keep that out of or I would say, let's put it a positive. How do you keep the culture intellectually honest so that you don't have that type of horse trading based on price, but underperformance of a thesis?
Honestly, you just gotta trust the people. So you just gotta trust Ven to be making those judgments and Rob to be making those judgments and the strategies. Happily, they have a lot of experience and have made plenty of mistakes, exactly that mistake you're talking about, to learn from, that set them up well for the work they're doing here and being true to that fundamental deterioration sell decision, which is what we call it. I also think culturally, as a CEO, part of what I can do to help investment teams is build them up a little bit when things have been tougher, and help remind them not to get too high up on their pedestal when things are going well, because either that underconfidence or that overconfidence in a portfolio manager psyche, I think, can really hurt them. So
yeah, that leads to risk management mistakes, right? I mean, not having you grounded in.
Especially that overconfidence. It kills you. You
Yeah.
think you're smarter than the world, and boom.
Brains in a bull market.
Get your face pounded in, right?
Often confused. Yes, I agree with you. And, can price ever cause permanent capital impairment? Is there I like company X, it's meeting all its mileposts, the stock's down 30%, I got to sell it. I mean, does that happen in your mind, or are your PMs wired that way, or?
No, honestly, no. On the domestic side, Rob and I will often set a initial purchase risk limit. So we'll say that no matter how much the stock goes down, we won't want to have put more than 4 or 5% into the position in total. which helps us avoid, if a name keeps getting cut in half and you keep taking it from 2 to 4%, all of a sudden you've lost 6 or 8% on a 1% position. It's like, how does that happen, right?
No, that can happen.
So that's one way that we try to address the risk of putting too much capital into a name as it declines. But no, there aren't hard limits on how much a stock price goes down. There are some cases where there are financial repercussions of a lower stock price or listing repercussions, other things that might play in. But generally, no, it's about tracking fundamental development and selling on deterioration.
Yeah, which is great. I mean, it's I think when you're running a wealth creation strategy, the more you're aiming for an absolute outcome, the less you can be influenced by price. I mean, price action. I mean, obviously you're trying to buy dollars for 50 cents. I mean, that's the purchase, but the 50 cents is a result of a misunderstanding, and as long as the misunderstanding is on a path to being cleared up, you feel like you're in good shape. And then paying attention to how all of the names in the portfolio work together, must be top of mind for each PM who's managing, his or her own risk, right? I mean, that has to be the way the system works.
It is, and a lot of that is based on their understanding of the fundamentals of each of the businesses, and what could happen to oil prices or to the uranium price or whatever it is that'll impact each of the different companies, and how those different things will work together or not work together, ideally be uncorrelated in the marketplace. I had another point, but it's gone.
No, you said the background, of generalist equity analyst or generalist equity PMs. That's also striking, right? And we kind of segue into the macro environment. It's October 29th, 2025 for the record, so people can know when we film this. But there's certainly a lot of macro elements going on in the marketplace today.
We're almost through October, which is good news for the year.
Right? And the trend is your friend. So, into year end, that's for this year anyway.
The big bad moves come in October.
Right. Let's see if we can get through the month and then through the end of the year. But
I'm reading 1929 right now.
Oh, right, of course.
Yeah.
It's equities markets at a high, so perfect. And it's the 20s again, so great time to market a book. But doesn't mean anything. But when you're thinking about the macro environment, you're not dividing the firm up by industry expertise. Again, I think when you're talking about the large firms, that's a unique difference. Right. Yeah. I mean, there is the idea that someone can analyze, Grand Canyon University and then turn around and think about uranium. I think that speaks to something about the structure of the firm. I don't quite know what, but you can sort of plug it into, because the macro environment is such that if you miss the AI trade, you're done. As you've said, well, maybe not. Our global equity guys haven't had any IT, and they don't have any healthcare. I mean, so how are you thinking about when you're talking to potential investors and they're asking you questions? I mean, you're going in with this generalist approach to equity ownership with a wealth creation mentality and high tracking error relative to benchmarks.
Yeah, I used to have a few favorite sector-specific conferences that I would pop in on. JP Morgan, for example, used to hold every year an awesome biotech little mini conference. Happened to be in Napa, California, which wasn't so bad. Yeah, really hard work. Yeah. Somebody's got to do it.
Yeah.
But I'd sneak my way in as a generalist to this conference every year, and it was the sector specialists at the biggest shops in the world, Capital Group, whoever. We're all there, and these guys and girls would be on a circuit. There'd be one of these every month that they'd go to, and you'd sit around the room and they were all friends and, they'd drink wine after together, all that stuff, which is great. All really, really smart on the areas. But they'd literally go on like 12 trips a year and listen to each other ask all of the same questions and get all of the same feedback from these management teams. Like, to me, the groupthink, and there would be things they disagreed on and they'd argue about it, but that would be all out in front of everyone too. Like, it was, I think, probably, generally speaking, a hard way to come up with really differentiated views on individual investments. And then we've owned and still own a firm, Gilead Sciences, since 2002. It was really the only biotech or pharma company that I spent a ton of time on relative to, an outstanding research coverage list of maybe 15 securities over 20 years. So that list of names that I'm following is probably smaller even than some of these sector-specific biotech analysts on this biotech tour. And when you're focused and investing for a long time, you can get really smart on that one name in an area. Like there are times when I would put my knowledge level about individual companies in areas that are pretty technical, like biotech or pharma, for example, up against any of those specialists, just because they were drawn pretty broad across this big list of companies they were covering on behalf of their firm and serving all these different portfolio managers and writing up reports, where we as a generalist could really dig in and really understand the dynamics in like one specific market. For example, in the case of Gilead, it's been the HIV market that has driven the business for 20 years. So it's just one market to really focus in on versus every therapeutic across every category. So I think as a sector specialist, there's a real vulnerability to losing the forest for the trees, for sure, and missing really big moves that are happening in the space just because you're too down in the weeds on it. And then because we've got a narrow list, very focused, compact portfolios, not that many names that we're following and covering, and we cover them for a long time, like we can get individual company-specific knowledge that is right up there with the best of a sector specialist. It's always something different that you need to learn about in each and every company, even within the same sector. So we do that same work. So I'm a huge fan of building that global generalist knowledge set, skill set, toolkit, being able to compare companies against each other to understand how they work in a portfolio together. And I honestly don't think we lose that much when it comes to individual company knowledge because we're just dipping in for that one name that we're excited about.
Well, it's differentiate. I mean, again, that's another part of what it's in the name, right? Different. I mean, so it's another way that you differentiate yourself from the active competitors, and I would even say from the passive competition, because the benchmarks get very tilted to sectors that are a la mode, or especially if they're market cap driven.
On that point, the work that Kiski's helped us to do on our baskets is really cool. There's a couple of 100 basis points of outperformance available relative to, say, the Russell 2500 in the SMID cap space or the S&P 500 in the large cap space, just on not paying attention to sector weights or company weights in the index, but balancing a portfolio based on our basket weights. So a passive implementation of our baskets, we think, actually adds value over the long term. To your point, these indices get super weighed to whatever the hot trend is. And then on top of that, of course, we hope to add idiosyncratic stock-specific alpha.
So, when you summarize all of this, I mean, there's a level of integrity, there's a level of patience, there's a level of expertise that you expect, there's a risk awareness. All of it adds up to it. Again, shocking to hear you talk about an investor asks for this, we just say no, or we're immediately disqualified from this. I mean, it's very refreshing to listen to you think about how you want to partner with your investors. Maybe just talk briefly about your thoughts there. And so when you're, what kind of capital base are you trying to attract to CDI? And it's almost like you've got a set of criteria that you're looking for to be met.
We did. I think it's a great question, Kevin. We did really interesting work. So I became a partner and an owner at the old firm in 2006 and was there through 2020. So participated in a lot of strategic planning meetings, got this awesome opportunity. The firm grew tremendously, got this awesome opportunity to learn a ton about the business of running an investment management firm, which I and my colleagues at City Different are trying to put to work, the learnings, right? One of the things that we did is I worked with the sales and marketing team to really dig in on which clients had the best outcomes investing in our strategies. There's this terrible problem in our industry of dollar-weighted returns trailing the stated track records of investment managers by more than 100 basis points. Power of compounding, that's a big deal over time. And it's mostly because investors get in after periods of good performance and then sell after periods of bad performance over and over and over again. It's the nature of the industry. I remember I was marketing two strategies on a trip to New York probably 10 years ago. Same philosophy and approach behind them. One had good recent performance, one had bad recent performance. I said the exact same things about who we are as a firm, how we approach it. And where I had good recent performance, you get the nods across the table. You can see that they buy in and they believe it. In same words out of my mouth, where the recent performance had been bad, you could tell looking across the table, they think it's the dumbest thing they have ever heard.
Of course it is.
It's the nature of our industry, right?
Yes.
So in this study, in this work that we did, we found, so I love RIAs partly because my dad founded and what these days we would call a registered investment advisor, an RIA, an independent financial advisory practice. They tend to be long-term oriented and relationship driven. Before they get too big, and it feels more like a wirehouse with a research team somewhere bringing names in and taking names out. But in that $500 million to $10 billion space, you can find some really long-term partnership-oriented clients that we think we're an awesome partner with. But in the institutional channel, at the old shop, we're working on institutional business. There are some long-term oriented and some not. We're going to try to find the long-term oriented. In our work at the prior place, it was like the closer you could get to an empowered decision maker who could really take on the risk of some underperformance, the better likelihood you had of that investor holding on through bad performance and having a good client outcome invested in our strategies. So that's what we look for. And then I'll say, even at the wires, which get a little bit of a bad rap in our industry, or at the regionals or the hybrids, there are teams that do outstanding long-term oriented work. They do outstanding emerging or discovered manager work that I think align well with who we are. But I think you do have to be, there can be some fast money there too, and there can be some pay to play there too. So you got to be very careful about who it is you're going after as clients. And one thing that's easy, Kevin, is like our message isn't going to resonate with a lot of people. Like we are who we are. We're not going to adjust it or change it based on what the other side of the table wants to hear from us. And that creates some automatic controls and keeping some of that shorter time horizon money out of our strategies too.
Well, again, it's refreshing in many ways, and I'm certain that, look, you guys have been at this for 5 years, but what you've managed to build from a cultural perspective and, just laying the foundation for, real scale. I mean, looking at every portfolio you have, you could scale it tremendously. I mean, is there any I should just ask the question, is there any capacity constraints in the way you're thinking about this, or?
We're a long ways off, but there are. I think in our SMID strategy, our current calculation of our capacity would be somewhere between 5 and 7 billion, say. We've got two flavors of our global equity strategy, which tracks the 20 to 30 slightly more diversified. Probably only a $1 to $2 billion capacity for our focused global equity strategy, the 10 to 20 stock. and maybe 5 to 7 in our 20 to 30 stock. So, firm-wide assets, $225 million today. We're not near capacity across any of those strategies, but in this industry, that can happen fast. So we are trying to think ahead to make sure that we're only running money that we believe we can run effectively on behalf of our clients. On the fixed income side, it's probably close to $10 billion, I think, that the team ran prior. I think the team could run effectively at CDI. And again, we got a lot of room to go. But come quick before it fills up.
That's it. Just a tent sale. When it was Veterans Day, Veterans Day sale. So, look, this has been great. I mean, we'll end with the culture because again, that's been at the forefront of how you've talked about the firm. But in the journal, there's an article about Zoom and back to office, and we were kind of joking about that before, but. You wanted me to ask you that question. So, what's your thought on the current zeitgeist around back to office and this?
There was just a Wall Street Journal article specifically on texting during Zoom meetings driving bosses crazy. My response to that is, maybe that's an indication that you're having too many meetings. I don't know.
And be more entertaining.
And maybe your meetings should be more engaging. That's exactly right.
Yeah.
I think this idea of meetings for meetings, feeding the bureaucracy at these large institutional organizations keep it up. It is a great competitive advantage for us that our investment teams get to spend time investing and not on all of the BS that's going on at some of these meetings. So I would tell those bosses that are pissed about the texting to check themselves, see if their meetings are engaging, if they're necessary, if it's not a little bit on them.
I love it. I mean, it's the perfect ending. It's a perfect ending. Thank you for. This is a lot of fun. Thanks for spending the time. Here in New York, it's great, and look forward to see you out in Santa Fe.
Yeah, this has been a blast, Kevin, and we've appreciated the long-term partnership with Kiski. The work you guys have done to help us be successful for our clients. So thank you.
Oh, we all we want is for you guys to be, to just kill it. So we're very, very happy to be partners with you. So thank you.
Great.
Okay.
Thanks, man.
Thank you.